The stock market is the cornerstone of world finance. It has a rich history that dates as far back as the 17th century, when the first exchange was established in Amsterdam. Today, the stock exchange has grown exponentially. In this video, we will look at how the stock market works and how you can navigate the stock markets if you want to trade. So, without much ado, let's get into it. To fully understand the stock market's workings, you must understand key concepts like shares or stocks, stock price, etc. So, let's look at some of these concepts. Shares. A share represents a fraction of ownership in a company. Simply put, if you buy or own a few shares of a company, you are part of its owners. However, the extent of ownership depends on the number of shares you hold. Also, as a shareholder, you may be entitled to a portion of the company's assets. The question is, how do you purchase a share? Shares can be bought and sold on stock exchanges. We'll dive into that in detail later. But note that the price of shares is never fixed. It fluctuates based on various factors, such as the company's performance, the country's economic conditions, and many more. But logically, the more a company thrives and makes a profit, its share price, also known as value, increases. Let's move on to the next term, stocks. These are company shares or equities a company decided to sell to the public. The primary purpose of selling stocks is to raise capital, which is crucial for the seamless operation of the company. This method of raising funds is a form of equity financing, which companies prefer over debt financing due to the absence of high interest rates associated with loans. Selling stocks also allows the company's top-performing employees or interested investors, just like you, to invest in the company, thereby giving you an opportunity to participate in its profits and growth. Initial public offering, IPO. An initial public offering, IPO, is a significant event in the life of a company. It marks a company's transition from being a privately held company to a public one. It allows the company to offer its shares to the general public. This is to tell you that not all companies can be traded in the public market. This is a crucial point to note because when doing your own background research on which company's stock to buy, note that you cannot buy shares or become a part owner of a privately held company. Dow Jones Industrial Average, DJIA, the Dow Jones Industrial Average, often referred to as the DJIA or the Dow, is a market index in the United States. It measures various sectors, including industry, transportation, and utilities, using leading companies in its calculations to represent the primary industries. Bull market. You may have heard this a million times. In the stock market, a bull market is a prolonged period of rising stock prices and extreme optimism among investors. During a bull market, investors' confidence is generally high, and they capitalize on rising stock prices to maximize their returns. This rise in stock prices is typically a result of demand for stocks exceeding supply. Logically, as an investor, the bull market is a perfect period to sell and not buy due to the hike in stock values. Bear market. The bear market is the opposite of a bull market. Unlike a bull market, a bear market represents a period of economic stagnation or slow growth. During this time, due to market uncertainties, investors often opt for bonds over stocks. In a bear market, stock prices tend to fall significantly, making it a perfect time to purchase more and hold for the long term. A bond is an investment security where an investor gives money to a company or government for a particular period and receives interest. It's like lending money to someone at a predetermined interest rate. There's usually a maturity date on bonds, and once the bond reaches maturity, the bond issuer returns the investor's money. Over-the-counter exchanges. Apart from the regular stock exchanges, we also have over-the-counter, OTC exchanges, often called bulletin boards or OTCBB. These platforms are a bit more loosely regulated and tend to list companies that don't meet the stricter listing criteria of more prominent exchanges. That makes the shares traded on OTC exchanges a bit riskier. Prominent exchanges often require a company to have been in operation for a certain period and meet specific company value and profitability conditions. In most developed countries, stock exchanges operate as self-regulatory organizations, SROs. These non-governmental bodies can create and enforce regulations and standards within the industry. The main goal of these SROs, which include individual stock exchanges, the National Association of Securities Dealers, NASD, and the Financial Industry Regulatory Authority, FINRA, in the US, is to protect investors. They do this by establishing rules that promote ethical practices and equality. Stock market indexes. These are essentially aggregated prices of several different stocks, and the movement of an index is the net effect of the movements of each stock it comprises. Major stock market indices include the Dow Jones Industrial Average, DJIA, and the S&P 500. The DJIA is a price-weighted index of 30 large American corporations. However, due to its weighting scheme and the fact that it only consists of 30 stocks out of the many thousands available, it's not the best indicator of overall stock market performance. On the other hand, the S&P 500, a market cap-weighted index of the 500 largest companies in the US, provides a much more accurate picture. Indices can be broad, like the Dow Jones or S&P 500, or specific to a particular industry or market sector. Investors can trade indices indirectly via futures markets or exchange-traded funds, ETFs, which behave like stocks on stock exchanges. A market index is a popular measure of stock market performance. Most market indices are market cap weighted, meaning the weight of each constituent is proportional to its market capitalization. However, a few, like the DJIA, are price weighted. Why companies issue shares? Imagine you're an entrepreneur with a brilliant business idea. To bring this idea to life, you'll need an office or factory, employees, equipment, raw materials, a sales team, and a distribution network, among other things. For each of these resources, you'll need a significant amount of capital, which varies based on the scale and scope of your business. To do that, you can offer your company's shares to the public. When a startup needs to raise capital, it has two main options: equity financing, which involves selling shares, or debt financing, which involves borrowing money. Debt financing can be tricky for a startup, as it may not have enough assets to secure a loan. Equity financing is often the preferred route for startups. The entrepreneur might initially fund the business using personal savings or money from friends and family. As the company grows and requires more capital, the entrepreneur might turn to angel investors and venture capital firms. When it gets to a point where a company needs to access more significant amounts of capital than it can get from its operations or a traditional bank loan, it might sell shares to the public through an initial public offering, IPO. This process changes the company's status from a private firm, whose shares are held by a few shareholders, to a publicly traded company, whose shares are held by many people. The IPO also allows early investors in the company to cash out part of their stake, often reaping substantial rewards. Once the company's shares are listed on a stock exchange and trading in the market, their price fluctuates as investors and traders continually assess and reassess their value. We can use many ratios and metrics to value stocks. The price to earnings, PE ratio, is among the most popular. Setting share prices. Now that we know why companies issue shares, we must understand how they set prices. The most common way share prices are set on a stock market is through auctioning. Buyers place bids, the price they're willing to pay, and sellers make offers or asks, the price they're willing to sell at. When a bid and an ask match, a trade happens. The stock market is a real-time showcase of supply and demand. For every stock transaction, there's a buyer and a seller. The price goes up if more people want to buy a stock, demand, then sell it, supply. The price decreases if more people want to sell a stock than buy it. The difference between the bid and ask prices is known as the bid-ask spread. It represents the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. If there are more buyers than sellers, they might increase their bids to get the stock, pushing the price up. If there are more sellers, they might accept lower offers, pulling the price down. If you enjoyed today's video, do leave a like and share with others. Also, you can subscribe to the channel for more helpful videos like this. Bye for now. Bye for.